Hey, it's Jeff Garber, mortgage expert and mortgage interest rate guru, coming at you for the week of Monday, May 2nd. And this is a big week. A lot of stuff going on the economic front. So I'm probably going to do two updates this week. One for what's going on in the market right now, but we actually have on Wednesday, May 4th is Fed Day. So that's a big day. And then Friday, May 6th, I believe, is jobs report, both of which are big market movers for mortgage rates. So what I want to do first is kind of get us caught up from what happened from last week to this week, show you where we are, then discuss a little bit about what could possibly happen with the Fed meeting on Wednesday, and we'll see if we can get an idea of what direction interest rates are heading. So let me get rid of me here. So what you're looking at here is mortgage rates, mortgage bonds. These trade in the bond market Monday through Friday. I repeat this every week. Red is a bad day, green is a good day. And in the bond market, as bond prices go down, as you can see in this nasty trend, rates are going up. Now, the good news is today we do have a green candlestick. Green is a good day, red is a bad day. So we want to see more green, because as green starts to go this way, rates would start to come down. Now, we've seen a couple of head fakes. I show this every week. We tried to recuperate here, which was last week, and we sold off. You can see a little bit of an attempt here, another one here, another one here. But at the end of the day, we're just in this nasty downward spiral in mortgage bonds, which means rates are going up. As a disclaimer, if you do want an accurate rate quote, you do need to speak to a licensed mortgage loan originator to get that. Right now, I'm just speaking very generally, and these are not rate quotes, but rates are in the fives. I've been saying that week after week that we've been kind of creeping up into the mid fives. And if bonds were to continue to sell off and go in this direction, it wouldn't be a far-fetched to say that rates could possibly be in the sixes. But we don't want that to happen. So we are hoping for some good luck here, and we are hoping that the bond market will take its cue from what happens on Wednesday, May 4th, and that is Fed Day. So let's talk about that for a little bit. So the Fed controls short-term overnight rates called the Fed funds rate. And the Fed meets every 6 weeks to come out with their policy statement. And we believe that this meeting, which is the May meeting, there'll be one in June and there'll be one at the end of July. We're fairly certain that the May and June meetings, the Fed is going to aggressively hike short-term rates, maybe up a half a point in May, maybe half a point in June, possibly a half a point or a quarter in July. Now, does that mean that mortgage rates are going to go up? And that is the big question, because most people think that when the Fed raises rates that they're raising mortgage rates, and that's simply not true. Now, we did have a rate hike of 0.25% 6 weeks ago at the last Fed meeting, and yes, we can honestly say that the Fed hiked rates and mortgage rates continued to rise. All right, we can all agree on that. But what the Fed is going through is called a cycle. And when the Fed cycle of rate hikes starts to kick in and does what it's supposed to do, which is curb inflation, all right, then you will see inflation and mortgage rates come down, because inflation is the kryptonite to the bond market and is therefore the kryptonite to mortgage rates. So when the Fed hikes rates, what they're actually trying to do is slow the economy down. As horrible as that sounds, but the only way to get control of inflation is to slow the economy down. Well, how do they do that? Well, they start a cycle of raising rates, because when the Fed hikes short-term rates, unfortunately, that means rates on everything else tend to go up, meaning car loan rates, possibly student loan rates, home equity line rates, credit cards, things like that. So if those rates are going higher, then people may think of possibly saving money instead of doing what they normally do, like going out to eat and spending money in other places. So that does actually start to slow the economy down. And when the economy slows, inflation will show. And I want to show you a little brief history lesson on this. And this is important. So what you're looking at here is a history and a pattern. And to be real brief, this is back in the early 80s. This is the Fed chairs at the time, Burns, then handing the torch over to Volcker. What you saw was inflation going from 7 to 14%. Mortgage rates, believe it or not, went from 12 to 18%. So we should actually be really pretty happy on where rates are today in the fives. The Fed funds rate, which is what the Fed is going to raise tomorrow at the Fed meeting, or I should say Wednesday, They took that from 11 to 20% during the cycle. Well, what happened? Inflation went from 14 to 5. Mortgage rates went from 18 to 12. Stock market measured by the S&P 500 was down 30%. Country went into a recession. It's not always a bad thing, but that's what happened. In comes Alan Greenspan, the maestro. He was the Fed chair throughout the 90s. Well, inflation went from 1.75 to 3.5. Well, he saw what these guys did and said, we better start hiking. We saw mortgage rates go from 7 to 8.5. We better start hiking the Fed funds rate. So he brought that from 4.75 to 6.5. Inflation response went from 3.5 to 1. Mortgage rates went from 8.5 to 5.5. Stock market went down 50%. We went into a recession. Come today, here we are, Jerome Powell, current Fed chair. All right, inflation has gone from 1.5 to 8.5%. All right, mortgage rates 2.5 to in the 5s, where we are at year to date. All right, Fed funds rate. We feel they're going to raise it from 0. We are now at 1/4, so we've already had one hike, to 3% in just 2022 alone. Well, if history repeats itself, what should happen? Inflation should drop, mortgage rates should drop. Unfortunately, stocks should sell off, and we might be heading for a recession. Again, not a bad thing, but when it comes to mortgage rates, typically this is the pattern that we've seen. So as inflation comes down, mortgage rates will come down with it. So if we go back to our chart here, tomorrow, I keep saying tomorrow because I'm not sure when you're going to be watching this. On Wednesday, May 4th, 2 p.m. Eastern Time, the Fed will probably hike 50 basis points or 0.5 point higher. So we'll go from 0.25% to 0.5% on the Fed funds rate. Okay? If the bond market likes that, which it may not yet, it might be too soon, well, we could see a reversal in the pattern here and maybe get a little bit of a rally and have rates stabilize or possibly come down. However, it may take a couple more rate hikes for the bond market to see that what they're doing is working and that they're going to get ahead of inflation. And once the bond market sees that, then we could see mortgage rates come down. So I expect a lot of volatility on May 4th, because usually the markets have to digest it. So we could have a volatile day in both directions tomorrow, but I'm going to break that down, okay? Because so Wednesday, May 4th is Fed Day. I will be recording another video on Wednesday, which I will probably get out on Thursday, May 5th. I will break down what the Fed did, what the markets reacted, what they said, because what they say in their policy statements can also give us clues to what they're going to do in the future. And the bond market likes transparency. So if it likes that, then maybe we start heading in the right direction here. At the time of this recording, we're actually not having a bad day. We're actually up 17 ticks on the day, which is good. And again, green is a good day. You can see that in this green candle. We're kind of getting back some of the losses that we got from yesterday. And then we will see what happens tomorrow. Again, this week, I'm going to have another update for you. I hope these are helpful. I am trying to educate and bring a kind of a boring topic to many, but it's kind of not boring when you're in the market for either a house or a refi. Of course, much less refi opportunities right now. But if you are in the purchase market and you want to know what's going on, this is it. This is our crystal ball. We are looking at 30-year fixed mortgages trade live, and we can tell exactly what our rate sheets are going to look like by what's going on in the bond market. I will be bringing you another video this week. Any comments, please post below. Also, check out my YouTube page. I call it the Mortgage Instruction Manual. So www.mortgageinstructionmanual.com. You can check out a lot of videos that I have there. I'm all about educating because mortgages don't come with an instruction manual, and I would like to be that instruction manual for you. Have a great day, and I will catch you soon.